The Great Depression was a global economic catastrophe that began in the United States with the stock market crash of October 24, 1929, known as Black Thursday. It was the longest and most severe economic downturn in the industrialized Western world, lasting for most of the 1930s. The genesis of the storm. What caused the Great Depression? The roots of the Great Depression were complex and multifaceted, extending beyond just the stock market crash. Several interconnected factors contributed to the perfect storm. 1. The Roaring Twenties excesses. The 1920s were a period of unprecedented economic growth and prosperity, but it was built on shaky foundations. Speculative stock market. Many people invested heavily in the stock market, often borrowing money to do so, believing prices would continue to rise indefinitely. This created an unsustainable bubble, overproduction and underconsumption. Industries produced more goods than consumers could afford to buy, leading to a surplus. Wages for many workers had stagnated, and household debt was rising. Unequal distribution of wealth. A significant portion of the nation's wealth was concentrated in the hands of a few, meaning the vast majority of the population lacked the purchasing power to sustain the booming economy. 2. The stock market crash of 1929. When the speculative bubble burst on Black Thursday, panic ensued. Millions of shares were sold by desperate investors, wiping out fortunes and shattering confidence in the American economy. While not the sole cause, it was the dramatic trigger that signaled the beginning of the end of prosperity. 3. Bank failures and panics. The stock market crash led to widespread bank failures. As people lost trust in banks, they rushed to withdraw their savings, causing even healthy banks to collapse. Over 9,000 U.S. banks failed, leading to a massive contraction of the money supply and a disappearance of credit. This made it nearly impossible for businesses to get loans, forcing them to close and lay off workers. 4. Agricultural crisis and the Dust Bowl. Even before the stock market crash, the agricultural sector was struggling. Overproduction after World War I led to falling crop prices, pushing many farmers into debt. To make matters worse, a severe multi-year drought began in 1929 across the prairies of North America, creating the Dust Bowl. Topsoil, loosened by extensive farming practices and lack of natural windbreaks, was swept away in massive dust storms, devastating farms and forcing hundreds of thousands to abandon their land in search of work elsewhere, often migrating to California. 5. Global economic interconnectedness and protectionism. The Depression was a global event. World War I aftermath. The war had disrupted international balances of power and the global financial system. Efforts to re-establish the gold standard, which fixed currency exchange rates, proved problematic. Lack of international coordination. As national economies faltered, governments and financial institutions turned inwards. The Smoot-Hawley Tariff Act in the U.S. 1930 raised tariffs on imported goods, intending to protect American industries, but instead crippling international trade as other countries retaliated with their own tariffs. This collapse in world trade deepened the crisis for all nations. The human cost. Life during the Depression. The impact on ordinary people was devastating and profound. Mass unemployment. By 1933, the height of the Depression, unemployment in the U.S. reached over 25%. In Canada, 20% of the labor force was out of work, and 1 in 5 Canadians became dependent on government relief. Millions lost their source of income, leading to widespread poverty and homelessness. Loss of homes and farms. With no income, many families couldn't pay rent or mortgages, leading to evictions and foreclosures. Farmers, especially in the Dust Bowl regions, lost their land. Shantytowns, dubbed Hoovervilles, a bitter nod to then-President Herbert Hoover, sprung up across the nation, built from scraps and discarded materials. Widespread hunger and malnutrition. Food was scarce for many. Stories of people rummaging through garbage for scraps, or of farmers having to destroy crops and livestock because prices were too low to justify harvesting or transporting them, highlighted the tragic paradox of plenty amidst poverty. While official starvation reports were rare, diet deficiency diseases were common. Social and psychological strain. The relentless hardship took a severe toll on mental and physical health. Family breakdown. The strain of unemployment and poverty led to increased divorces and family abandonment. Many young people, unable to be supported by their families, left home and rode the rails as hobos in search of work. Loss of dignity and hope. For many, the inability to provide for their families led to deep feelings of shame and despair. The suicide rate increased dramatically. Unequal burden. While everyone suffered, the burden was often heavier on marginalized groups, including racial minorities and immigrants, who faced intensified discrimination and limited opportunities. Changes in daily life. Frugality became a way of life. People mended clothes, repurposed items, and stretched every penny. Many children had to quit school to help their families find work. The dawn of a new era, the New Deal. In the face of unprecedented crisis, President Franklin D. Roosevelt, elected in 1932, introduced a series of programs and reforms known as the New Deal. Based on the belief that the federal government needed to actively intervene to get the country out of the Depression, the New Deal aimed at relief, recovery, and reform. Key New Deal programs included Relief programs. Civilian Conservation Corps, CCC, employed hundreds of thousands of young men in conservation work, such as reforestation and flood control. Works Progress Administration, WPA, created jobs on public works projects, building roads, bridges, schools, and parks. It also funded arts and cultural projects. Federal Emergency Relief Administration, FERA, provided direct cash payments to states for distribution to the needy. Recovery programs. Agricultural Adjustment Act, AAA, aimed to raise agricultural prices by paying farmers to reduce crop and livestock production. National Recovery Administration, NRA, sought to stabilize industrial production by establishing industry-wide codes for fair competition, minimum wages, and maximum hours, later declared unconstitutional. Tennessee Valley Authority, TVA, brought cheap electricity and flood control to a vast, impoverished region. Reform programs. Federal Deposit Insurance Corporation, FDIC, insured bank deposits, restoring public confidence in the banking system. Securities and Exchange Commission, SEC, regulated the stock market to prevent speculative excesses and dishonest practices. Social Security Act, 1935, perhaps the most far-reaching, it established a national system of old age pensions, unemployment compensation, and aid for dependent children and the disabled. This marked a significant shift in the government's role in social welfare. Wagner Act, National Labor Relations Act, greatly strengthened the rights of labor unions to organize and bargain collectively. Effectiveness of the New Deal. While the New Deal did not end the Great Depression, full recovery came with the massive spending of World War II. It significantly alleviated suffering, stabilized the financial system, and laid the groundwork for a more robust social safety net. It also profoundly changed the relationship between the American people and their government, establishing the precedent for federal intervention in economic and social affairs. The lasting legacy. The Great Depression left an indelible mark on society, shaping economic policy, social attitudes, and political landscapes for decades. Increased government intervention, the New Deal, fundamentally expanded the role of the federal government in the economy and in providing social welfare. Programs like Social Security and unemployment insurance became permanent fixtures. Shift in political alignment. The crisis led to a long period of Democratic dominance in U.S. politics and a general shift leftward in American political ideology, with a greater acceptance of government regulation and social programs. Economic policy evolution. The Depression spurred the development of new economic theories, such as Keynesian economics, which advocated for government spending to stimulate demand during recessions. Psychological impact. Generations who lived through the Depression often carried a deep sense of frugality and caution about financial matters. Rise of extremist ideologies. Globally, the economic instability and desperation fueled the rise of extremist political ideologies like fascism in Europe, contributing to the conditions that led to World War II. The Great Depression was a stark reminder of the fragility of economic systems and the profound human cost of widespread financial collapse. It remains a crucial chapter in history, offering invaluable lessons about economic resilience, social responsibility, and the role of government in times of crisis. Let's dive into the economic landscape of the Great Depression, particularly focusing on Canada, and then compare it to today's world, finally looking at the warning signs that often precede such a severe downturn. The economy back then. Canada and globally. The economy leading up to and during the Great Depression was characterized by a specific set of circumstances. Reliance on primary resources. Canada's economy in the 1920s and 30s was heavily reliant on exports of primary products like wheat, timber, fish, and minerals. When global demand for these commodities plummeted and prices fell drastically, Canada was hit exceptionally hard. Saskatchewan, for example, saw its income drop by 90% in 2 years due to historically low grain prices and the devastating Dust Bowl. Overproduction. In the Roaring Twenties, industries, both manufacturing and agriculture in many developed nations, including Canada and the U.S., significantly increased their production capacities. However, consumer purchasing power didn't keep pace, leading to a surplus of goods that couldn't be sold. Stagnant wages and rising debt. While industrial output grew, wages for many workers remained relatively stagnant. This, coupled with the allure of new consumer goods, led to an increase in household debt. Speculative bubbles. The stock market was a prime example of a speculative bubble. Many people, including ordinary citizens, invested heavily, often on borrowed money, buying on margin, betting on continuous price increases rather than underlying company value. This created an unstable market, susceptible to collapse. Weak and unregulated financial systems. Banks were often poorly regulated and lacked the safeguards we see today. Many invested heavily in the stock market themselves, and without deposit insurance, like the CDIC in Canada or FDIC in the US, bank runs were common. When people lost faith in a bank, they rushed to withdraw their money, causing even solvent banks to collapse. This led to a massive contraction of the money supply and credit, protectionism, and collapse of international trade. Countries, in an attempt to protect their domestic industries, enacted high tariffs, like the Smoot-Hawley tariff in the U.S. This led to retaliatory tariffs from other nations, effectively choking off international trade, which was a vital component of the global economy. Canada, heavily dependent on exports, was particularly vulnerable to this. Deflation. As demand plummeted and production outstripped consumption, prices for goods and services fell significantly, a phenomenon known as deflation. While it might sound good to consumers, deflation discourages spending and investment because people expect prices to fall further. It also makes existing debt more burdensome, as the real value of the debt increases. Limited social safety nets. Before the Great Depression, social welfare programs were minimal or non-existent in most countries. There was little to no unemployment insurance, widespread government relief, or old age pensions. This meant that when people lost their jobs or savings, they had very little to fall back on. In Canada, gross national product fell by 42% in current dollars and 29% in constant dollars, accounting for deflation, between 1929 and 1933. Exports declined by almost two-thirds. Unemployment reached 20% of the labor force by 1933, and 1 in 5 Canadians became dependent on government relief. How today's world and back then are different. The world economy today, and particularly Canada's, is significantly different from the 1920s and 30s, making a repeat of the Great Depression, as it happened then, highly unlikely. Here are key differences. 1. Stronger financial regulations and institutions. Deposit insurance. In Canada, we have the Canada Deposit Insurance Corporation, CDIC, and in the U.S., the FDIC. These agencies insure bank deposits, preventing widespread bank runs and restoring public confidence in the banking system. Central banks with more power. The Bank of Canada, established in 1934, partly in response to the Depression, and other central banks globally, have far more sophisticated tools and mandates to manage the money supply, interest rates, and financial stability. They can act as lenders of last resort to prevent bank failures and inject liquidity into the system. Stricter banking regulations. Banks are now subject to more stringent capital requirements, risk management protocols, and oversight, making them more resilient to economic shocks. Stock market regulation. Agencies like the Ontario Securities Commission, OSC in Canada, and the SEC in the U.S. regulate stock markets, aiming to prevent excessive speculation, insider trading, and fraudulent activities. 2. Robust social safety nets. Unemployment insurance, EI. Canada has a comprehensive employment insurance program, providing temporary financial assistance to unemployed workers. Similar programs exist in many developed countries. Social security/pensions. Programs like the Canada Pension Plan, CPP, and Old Age Security, OAS, provide income support for retirees and those with disabilities, ensuring a baseline level of income even during economic downturns. Welfare programs and social assistance. Governments now provide various social assistance programs to support low-income individuals and families. 3. Diversified economies. While natural resources are still important for Canada, the economy is much more diversified, with significant contributions from services, manufacturing, technology, and other sectors. This reduces vulnerability to price fluctuations in a single commodity. 4. Global cooperation and institutions. International organizations like the International Monetary Fund, IMF, and the World Bank work to promote global financial stability, facilitate international trade, and provide assistance to countries in economic distress. There's a greater understanding of global economic interconnectedness and the need for coordinated responses to crises. 5. Active fiscal and monetary policy. Governments and central banks are much more proactive in using fiscal policy, government spending and taxation, and monetary policy, interest rates, money supply, to mitigate economic downturns. During a recession, governments are more likely to implement stimulus packages, and central banks can cut interest rates or engage in quantitative easing. 6. Better economic data and analysis. We have much more comprehensive and timely economic data today, allowing policymakers to identify problems earlier and respond more effectively. However, challenges remain, such as high household debt, housing affordability issues, and concerns about productivity growth in Canada, as well as global trade tensions and geopolitical instability. While these are serious, they do not mirror the systemic vulnerabilities of the 1930s. Telltale signs before a Great Depression or severe recession. While no two economic crises are identical, there are common warning signs that often precede severe downturns like the Great Depression. 1. Excessive speculation and asset bubbles. Rapidly rising asset prices. Stocks, real estate. When prices of assets increase significantly faster than underlying economic growth or company earnings, it can indicate a bubble. This is often fueled by easy credit and a fear of missing out mentality. High leverage/buying on margin. A significant increase in borrowing to invest in assets, e.g., buying stocks with borrowed money, amplifies risk. When prices fall, these leverage positions can trigger forced selling, accelerating the decline. 2. Widespread debt accumulation. High household debt. When consumers are carrying excessive levels of mortgage debt, credit card debt, or other loans, they become more vulnerable to economic shocks, as a loss of income can quickly lead to defaults. High corporate debt. Businesses taking on too much debt, especially for speculative ventures rather than productive investment, can become fragile. Rising government debt, though less direct a cause in 1929, while not a primary cause of the Great Depression, high government debt can limit a government's ability to respond to a crisis through fiscal stimulus. 3. Overproduction and underconsumption. Inventory buildup. Businesses producing more goods than consumers are buying, leading to a glut of unsold inventory. This indicates a mismatch between supply and demand. Stagnant wages or declining real incomes. If wages don't keep pace with productivity growth or inflation, it can limit the purchasing power of the general population, exacerbating the problem of overproduction. 4. Weak or inefficient financial systems. Lack of regulation, insufficient oversight of banks, investment firms, and financial markets can allow risky practices to proliferate. Interconnectedness of financial institutions. When many institutions are heavily linked, the failure of one can trigger a domino effect across the entire system. Bank failures and credit crunch. A series of bank failures, often due to bad loans or runs on deposits, can dry up credit, making it difficult for businesses to operate and expand. 5. Deflationary pressures. Falling prices for goods and services. A sustained and broad-based decline in prices can signal a lack of demand and encourage consumers to delay purchases, further stifling economic activity. Falling commodity prices. For resource-dependent economies like Canada's was, a sharp and sustained drop in the prices of key exports is a major warning sign. 6. Protectionist trade policies. Rising tariffs and trade barriers. A global shift towards protectionism, where countries erect barriers to international trade, can severely disrupt supply chains and reduce overall economic activity. 7. High unemployment, especially rising rapidly. While unemployment is a characteristic of a downturn, a sudden and significant increase in unemployment before a recognized recession can be a strong indicator of underlying economic weakness. 8. Declining consumer and business confidence. Surveys of confidence. Indices that measure how optimistic consumers and businesses are about the future of the economy can be leading indicators. A sharp drop in confidence often precedes a reduction in spending and investment. It's important to note that a single one of these factors rarely triggers a depression. It's usually a confluence of several, interacting and reinforcing each other, that creates a systemic crisis. Economists and policymakers constantly monitor these indicators to identify potential risks and implement preventative measures to avoid a repeat of the Dirty 30s. The Great Depression offers a wealth of lessons beyond the immediate economic mechanics. Here are some important facts and lessons often overlooked, especially from a human and societal perspective. Overlooked facts and nuances. 1. The Depression didn't start with the crash for everyone. While Black Thursday, October 24, 1929, is the symbolic start, many industries, particularly agriculture, were already in a depression-like state for years prior due to overproduction and falling prices. The stock market crash was the dramatic signal that the urban and industrial parts of the economy were now joining the downturn. 2. The Roaring Twenties weren't roaring for everyone. Beneath the veneer of prosperity, significant income inequality existed. Many farmers, laborers, and marginalized communities did not fully participate in the economic boom and were already struggling before the crash. This inequality contributed to the underconsumption problem. 3. The gold standard's role. While complex, the gold standard played a crucial and often overlooked role in deepening and prolonging the depression globally. It forced countries to prioritize maintaining their gold reserves over stimulating their economies. Nations that abandoned the gold standard earlier, like Britain, tended to recover faster. The Bank of Canada Museum highlights this as a key obstacle to relief. 4. Deflation as a deeper problem than inflation. We often worry about inflation, rising prices, but deflation, falling prices, was a major and destructive force during the Depression. It made debts more burdensome, as the real value of the money owed increased, discouraged spending, as people waited for prices to fall further, and made it impossible for businesses to turn a profit. 5. The psychological toll was immense. Beyond the financial ruin, the Depression caused immense psychological distress, shame, and despair. Men, traditionally seen as providers, often felt a profound loss of dignity when they couldn't find work. This led to family breakups, increased rates of mental illness, and a general erosion of hope. 6. Resourcefulness and community, not just government aid. While the New Deal was vital, people survived largely through incredible resourcefulness, self-sufficiency, and community support. Bartering, repairing instead of replacing, Depression-era recipes, stretching meager ingredients, and extended families living together were common. Neighborhoods and communities often provided informal safety nets, where official ones were lacking. 7. The unequal impact. The Depression disproportionately affected marginalized groups. African Americans, indigenous peoples, and recent immigrants faced even higher unemployment rates, greater discrimination, and limited access to whatever meager relief was available. The Dust Bowl migrants, often called Okies, also faced severe prejudice in their new homes. 8. The slow road to recovery. The New Deal eased suffering and laid foundations for recovery, but full economic recovery didn't occur until the massive industrial mobilization for World War II. This demonstrates the immense scale of the crisis and the sustained effort required to overcome it. Important lessons to learn. 1. The danger of unchecked speculation and debt. The Depression stands as a stark warning against allowing speculative bubbles in stocks, housing, or other assets to inflate unchecked, especially when fueled by excessive leverage and easy credit. Both individuals and institutions need to be wary of too good to be true investments and unsustainable debt levels. 2. The necessity of a robust social safety net. The Depression highlighted the catastrophic consequences of having no social safety net. Programs like unemployment insurance, old age pensions, Social Security, and direct relief are now seen as essential stabilizers that cushion the blow of economic downturns, preventing widespread destitution and maintaining basic demand. 3. The vital role of government intervention. The initial hands-off approach proved disastrous. The New Deal demonstrated that active government intervention, through fiscal stimulus, regulation, and social programs, can be crucial in times of severe economic crisis. This fundamentally changed the philosophy of government's role in the economy. 4. The importance of financial regulation. The collapse of thousands of banks and the chaotic stock market demonstrated the critical need for strong financial regulation, e.g., deposit insurance, securities regulation, central bank oversight. These regulations protect consumers, maintain confidence, and prevent systemic risks. 5. Global interconnectedness and cooperation. The Depression's global spread emphasized that economic crises are rarely confined to one nation. Protectionist policies like high tariffs worsen global downturns. International cooperation and free, fair trade are crucial for global economic stability. 6. The value of frugality and self-reliance. Even today, while we have more safety nets, the Depression taught invaluable lessons about personal finance. Emergency funds. The importance of having savings, an emergency fund, to cover living expenses during job loss or unexpected events. Avoiding excessive debt. The fragility that comes with being over-leveraged, whether for personal consumption or investments. Resourcefulness and practical skills. The ability to fix things, grow food, cook at home, and generally make do with less can provide significant resilience. 7. Resilience of the human spirit and community. Despite immense hardship, people found ways to adapt, support each other, and maintain hope. The era showed the power of community bonds and collective action in overcoming adversity. 8. Beware of simplistic solutions and blame. The Depression was complex, with multiple causes and no single villain or easy fix. Be wary of political rhetoric that simplifies economic problems or seeks to assign blame without a nuanced understanding of the systemic factors at play. By understanding these deeper facts and lessons, we can appreciate the profound impact of the Great Depression and apply its wisdom to navigate present and future economic challenges. The Great Depression was a global phenomenon, but its severity varied significantly from country to country, largely depending on their economic structure, reliance on international trade and finance, and government responses. Here's a breakdown of countries that were particularly hard hit and some that fared relatively better. Countries that had it worse. 1. Germany. Post-World War I. Debt and hyperinflation. Germany was already in a fragile state after World War I, burdened by heavy war reparations and a period of hyperinflation in the mid-1920s. Reliance on U.S. loans. Its economy relied heavily on short-term loans from the United States, Dawes Plan, Young Plan, to make its reparation payments and rebuild its industry. When these loans were recalled after the Wall Street crash, Germany's financial system collapsed. Massive unemployment. Unemployment soared to nearly 30% by 1932, affecting millions. Industrial production fell by 41% between 1929 and 1932. Political instability. The severe economic hardship and the inability of the Weimar Republic to effectively address the crisis fueled widespread disillusionment and resentment, paving the way for the rise of Adolf Hitler and the Nazi Party. The economic misery was a direct catalyst for political extremism. 2. United States. Origin of the crash. As the epicenter of the stock market crash and with a highly speculative economy, the U.S. experienced the initial shock and a deep contraction. Bank failures. The U.S. had a fragmented banking system with many small, independent banks. Over 9,000 banks failed, wiping out savings and paralyzing credit. Canada, by contrast, had a more centralized and stable banking system with no failures. Mass unemployment. Unemployment reached a staggering 25% nationally by 1933, and even higher in some industrial areas. Industrial production plummeted by 46%. Agricultural devastation. Dust Bowl. The added natural disaster of the Dust Bowl on the Great Plains compounded the economic woes for American farmers. 3. Canada. Heavy reliance on exports. Canada's economy was, and still is, to a lesser extent, heavily dependent on exporting primary products like wheat, timber, and minerals. When global demand and prices for these commodities collapsed, Canada's export-driven economy was devastated. Proximity to U.S. Given its close economic ties, Canada was highly vulnerable to the downturn in the U.S. The Smoot-Hawley Tariff Act, in particular, severely damaged Canadian exports to its largest trading partner. Prairie drought. Similar to the U.S., Canada's prairies also suffered a severe, prolonged drought, which was the Canadian equivalent of the Dust Bowl, further crippling the agricultural sector. Significant decline. Canada's gross national product fell by 42% in current dollars, 29% in constant dollars, from 1929 to 1933. Industrial production fell to 58% of its 1929 level, the second lowest decline after the U.S. unemployment reached 20%. 4. Australia. Commodity dependence. Like Canada, Australia was highly reliant on exports of primary products, especially wool and wheat. The collapse in global commodity prices severely impacted its economy. High unemployment. Unemployment reached a staggering 30% in 1932. Withdrawal of British loans. The drying up of overseas loans, particularly from Britain, exacerbated Australia's financial crisis. 5. Latin American countries, especially Chile. Vulnerability to commodity prices. Many Latin American economies were structured around the export of one or two primary commodities, e.g., copper in Chile, coffee in Brazil. When demand and prices for these commodities plummeted due to the global recession and protectionist policies, their economies suffered immensely. Collapse of exports. Chile, heavily dependent on nitrate and copper exports, saw its exports drop by an astounding 83% between 1929 and 1932. Its industrial output fell by 37%. Debt defaults. Many Latin American nations defaulted on their foreign debts, leading to a breakdown in international credit. Countries that fared relatively better, or differently. 1. Soviet Union, USSR. Isolation from world economy. The Soviet Union, under Stalin's command economy, was largely isolated from the global capitalist system. It was undergoing rapid industrialization under its 5-year plans and was not integrated into international financial markets. Internal hardship. While it avoided the capitalist depression, it suffered immense internal hardship, including widespread famine, e.g., the Holodomor in Ukraine, as a result of forced collectivization and brutal purges, which were distinct from the market-driven collapse experienced elsewhere. 2. Japan. Devaluation and export boost. Japan was one of the first countries to devalue its currency, the yen, against the gold standard in the early 1930s. This made its exports cheaper and more competitive, allowing it to recover relatively quickly through export-led growth. Military expansion. Increased military spending and expansionism also stimulated its economy, albeit with dire long-term consequences. 3. United Kingdom. Earlier downturn. The UK's economy was already experiencing a downturn throughout the 1920s, which meant it was less susceptible to the shock of the 1929 crash than the US or Germany. Abandonment of gold standard. Britain abandoned the gold standard in 1931, which allowed its currency to depreciate and boosted its exports. Diversified economy. While still industrial, its economy was more diversified than many primary commodity exporters. While it faced high unemployment and hardship, its industrial output fell less severely than in the US or Germany, 23% versus 46% and 41% respectively. 4. France. Delayed impact. France's economy was less integrated into global finance and more agricultural, leading to a somewhat delayed impact of the Depression. Prolonged stagnation. However, once the Depression hit, France experienced a more prolonged period of stagnation and did not return to pre-crisis growth rates until later in the decade. In summary, countries heavily reliant on commodity exports and those with fragile financial systems, or those deeply intertwined with U.S. finance, like Germany, experienced the most devastating effects of the Great Depression. Nations that were either more isolated or those that quickly adapted their monetary and trade policies, like Japan and the UK abandoning the gold standard early, tended to weather the storm more effectively. The Great Depression, a decade-long period of severe economic downturn, did not end due to a single event or policy. Instead, it was a complex process influenced by a combination of factors, with the most significant being the onset of World War II. Here's a breakdown of how the Great Depression ultimately came to an end. 1. The limited effectiveness of the New Deal and similar policies in other countries. While the New Deal in the United States and similar government interventions in other countries, like Canada's more cautious but evolving social welfare policies, brought significant relief, restored some confidence, and laid the foundation for a modern social safety net, it did not fully end the Depression. Relief, recovery. Reform. New Deal programs like the Civilian Conservation Corps (CCC), Works Progress Administration (WPA), and the Agricultural Adjustment Act (AAA) provided jobs, stabilized prices, and offered direct aid. Financial reforms like the FDIC and SEC strengthened the banking system and regulated the stock market. Keynesian economics. President Roosevelt, particularly after 1937, began to adopt more Keynesian principles, recognizing the need for government spending to stimulate aggregate demand. However, the scale of the spending, while substantial for the time, was still not enough to overcome the massive economic contraction. Persistent unemployment. Despite these efforts, unemployment remained stubbornly high throughout the 1930s. In the U.S., it was still around 15% in 1939, and in Canada, it remained above 12% until the war began. Private investment, crucial for a full recovery, also lagged. The single most decisive factor in ending the Great Depression globally was the outbreak and escalation of World War II, 1939 to 1945. Massive government spending. The declaration of war, Canada entered in September 1939, the U.S. in December 1941, triggered an unprecedented surge in government spending. Countries had to rapidly mobilize their economies for war, leading to massive government contracts for weapons, ammunition, vehicles, ships, and other war materials. Industrial mobilization. Factories that had been idle or operating at reduced capacity were retooled for war production. This created an enormous demand for raw materials and manufactured goods. Full employment. Millions of people who had been unemployed were now employed in war industries. Furthermore, millions more joined the armed forces, effectively removing them from the unemployment rolls. In the U.S., unemployment plummeted from about 15% in 1939 to effectively full employment, around 1 to 2% by 1943. In Canada, the war effort similarly led to a dramatic reduction in unemployment, as factories ramped up production of war supplies for both the Canadian and Allied forces. The demand for workers was so high that women entered the workforce in unprecedented numbers to fill roles traditionally held by men. Increased wages and consumer spending. With full employment, wages rose and people had money to spend. Although rationing and war bond drives diverted some consumer spending, the overall increase in economic activity was immense. Revitalization of trade among allies. While global trade was initially disrupted, the war created new trade patterns and demand among allied nations, particularly between North America and Europe. In essence, the Great Depression was a crisis of insufficient demand and collapsed credit. The New Deal attempted to stimulate demand and stabilize the financial system. However, it was the massive, sustained, and undeniable demand generated by a global war effort that finally provided the colossal economic stimulus needed to put millions back to work, fully utilize industrial capacity, and pull economies out of the prolonged slump. The war forced governments to engage in deficit spending on a scale far beyond anything contemplated during the New Deal, proving the power of massive public expenditure to overcome a depression. While the human cost of the war was immense, its economic impact was undeniably the force that finally ended the Great Depression.